Hi, good morning, and welcome to the live quarterly market update from Morton Brown Family Wealth. Good morning, everyone. I'm Dennis Morton. We have Katie Brown and Cody Demmel here with us this morning.
Hi, everyone.
Guys, before we get started today, we need some intro music. Next time we're going to have something's got to walk us in. So, Cody, I'm going to task you with coming up.
I don't know if I'm going to be the best to pick that song, but I'll do my best.
The hard part is for this market update, do we need like ominous beats or do we need something light and uplifting? I'll leave that for you to figure out next time. But
perfect. Perfect.
The cold intro's got to go. So welcome everyone. We do these live market updates because we talk about the markets all the time and how it impacts planning and investing for our clients and just how we think about the world around us. So we just want to spend this time talking a little bit about where we are in the markets, the kind of advice we're giving clients, the way we're talking to people these days, and then go through some slides that might help provide some context around what I think, Katie, I think this, in a very subtle way, has been a big year for change in the markets. And it's been masked by really good performance, but change is all around us. So let's talk about where we are now. What are some things that you're noticing these days?
Yeah. I mean, you're exactly right. It's a big year for change. And it's interesting because we talked about that quite a bit coming into this year. We knew some changes were coming, but you're always surprised by what comes up. We are sitting at a point right now where we are at all-time highs in the stock market. So we're seeing really, really strong market growth. At the same time, we're seeing really, really high, like almost all-time high balances when it comes to money markets, really strong gold. We're seeing yield on bonds. A lot of things that don't always move in the same direction are tracking in the same direction this year.
Yeah, it's almost, when we talk to clients, it's almost like pick your narrative. People say, wow, gold's at an all-time high. That means this. But then stocks are at all-time high and everything else. So it's, I think there's some elements that make this feel late cycle. Like people are just, pushing money into a lot of forms of speculation. The Wall Street Journal had an article recently talking about that applies to whether it's sports betting or anything else. There's just a speculative fervor about, but there are also some things that we think are constructive. Like, how do we approach this feeling like, yes, everything's up, but are we standing at a precipice? Are we looking at lower returns in the future? What do you do if you're someone looking around and saying, yes, things are good, but?
Right. We talk about this a lot. It's always bringing it back to you. So when you look around and say, okay, I feel as if I'm in a pretty good spot right now. Things are in a good spot. Don't know if they're going to stay here. We don't know what's going to happen in the future, but let's make sure that we're taking productive steps right now so that when you fast forward, you say, okay, at a time when everything was at its highs, what do I wish I would have done? And I think that starts with a little bit of self-awareness. I think it's reflecting on where are you, personally, financially, where do you stand, amidst your goals, and really starting to reflect a little bit on your current situation.
Yeah, because here's the situation I imagine. We've had this come up recently. I'll give the example of a new client that's coming on board where we had talked to them years ago and they popped up again recently and said, I think it's time we start working together. And they're within a year of retirement and they showed me their investment portfolio and it's 98% stocks. And, in a situation like that, the first thing that comes to mind is, great, you've done really well. Now's the time to start thinking intentionally about what do you do from that position of strength, because that's probably not the right way to be positioned, but that good performance can mask some of the things that we want to do. I think Jason Zweig in the Wall Street Journal had a great line a couple weeks ago. He said, when the markets feel safer, like in an extended bull market, people's behavior becomes riskier. Like the risky stuff feels safe. And I think the thing that we want to point out is it's not the risks that we're all aware of, it's the perception of safety. And the more we perceive things to be safe because they're going up, the more risk builds up. So, Katie, what are some questions that people can ask themselves right now that would be apply the energy into the constructive things you can do when the markets are high?
Well, I think there's always, starting just kind of at the baseline. Do you know what you own? Do you understand the risk that's present there? I do think, especially as you get kind of later in these cycles, there's, like you said, there's that perception of safety and sometimes that feeling of, well, I should hop over there because other people are making a lot of money there, almost that like chasing. And I think pausing for a minute to ask, okay, why? What does that, if you're looking to build a bigger pile of money, what is that funding and what is your time horizon for that funding? Because maybe you don't need to take on that extra risk, or maybe you need to, reflect on what you have and your goals coming up and actually de-risk and pull some things back at a time when other people might be racing forward. That might be the best thing for you and your plan. So I think understanding what your plan is and what you own and when you need those things to show up for you to make sure that you're aligning them appropriately.
And I just want to be careful that when we talk about taking action, it's not about becoming more defensive. It's not the reactive thing of saying, oh, it's time to move to cash, or it's time to it might be an aggressive move, like it's time to gift something. Maybe it's time to gift within the family or make that philanthropic gift because you have appreciated stock or all those things. It's, I think sometimes the action when the markets are down is, it's a lot of times it's how do we manage risk in a defensive way, but there's managing risk in a proactive way. I think one of the other questions, the important question is, what's changed for you recently? We have, one of the common questions we have is things that are happening out there in the markets. And that's a frequent thing that we can pay attention to because we just have to turn on the news to see it. But what's changed for you? Has your timeline, as you pointed out, Katie, has your timeline changed? Has your intention changed? Has your risk tolerance changed? You can look and say, how did I react during a previous downturn? And do I think I'd react differently this time? Am I now retired where before I wasn't? Am I now needing income where before I wasn't? Those types of things. Asking those kinds of questions. Ideally, we're serving as a sounding board for those types of things. But So Katie, just to kind of put a bow on this, what do you think the next best thing people could be doing between now and year end to be proactive and intentional in their planning?
Bringing that alignment back, really, you said going through asking those questions and recognizing, okay, maybe things are different and how do I need to realign? Let's make sure to bring it back to the plan. Make sure that your investments, once again, you're lowering the risk for the things coming up in the near term, and you're recognizing you can ride some waves for things that are in the longer term, but making sure that you have a solid understanding of that risk and then also how you internalize it, because that's what's going to build that confidence or not build that confidence. So it's that alignment really with the plan.
Yeah.
So go ahead.
Yep. No, here we go. We're gonna bring Cody back on and pivot over to some of the presentation that we have.
Yeah.
Cody, walk us through some of the slides and update us on what's been happening in the markets.
Yeah. And as Cody's getting geared up here, just a reminder, we do have a chat box. We welcome any questions at any point during the presentation to where we can work them into the conversation. We will definitely do that. And if we don't get to all of them, we'll make sure to address them at the end. So please feel free to stick around. We might go over a little bit of Q&A at the end too. Just talk about some things that we're hearing and some conversations that we're having with clients. So we hope you join us.
All right, awesome. So as always, we want to take a balanced approach going forward, and then obviously looking at the past, third quarter. So going over, the glass half full outlook going forward. Global stocks continued their upward trend, both inside the US and internationally in the third quarter. The near-term recession risks continue to fade a little bit inside of the US, and Katie's going to go over that in a little more detail here coming up. The US GDP for the second quarter was 3.8%, and as of now, it's expected to show similar growth in the third quarter. And I'm sure everybody knows the Fed lowered the interest rates for the first time in 2025 at the end of the third quarter, and then also has another decision coming up next week. So those are the glass half full outlooks going forward. Glass half empty. The labor market is showing signs of softening. So the job numbers have came down a little bit in the third quarter. The Fed's preferred inflation measure, which is the core PCE, is still above their 2% target at around 2.9. But obviously it's still a lot lower than where we were just a couple years ago, which is why they're starting to cut interest rates. And then another potential, concern for people going forward is there's been a lot of spending within AI related investments, but the future, revenue streams right now are still a little foggy. And then obviously, I'm sure everybody knows, at the end of the third quarter, we ended with a government shutdown inside of the US, and obviously we're still, in that period right now. So Katie, will have you go over some of the, more detailed economic growth.
Katie, or Cody, can I touch on something here on this slide real quick?
Oh, yeah. Yeah.
I've had some flashbacks recently to, 10, 15, I just crossed over 20 years in this industry, and there's been a lot of, market volatility in that time. 10 years ago, if we were giving this presentation, we would have been talking about how the inflation was hovering stubbornly at 1%, with the Fed wanting to be at 2%, and they couldn't get it to 2%.
Yeah.
Janet Yellen, the chair of the Fed at the time, called it an enigma. We can't figure out why we can't get inflation to 2%. And I just think it's interesting that now we're sitting at 3%, and we're wondering why we can't get it to 2%. So it's just,
yeah.
With in the long view, I don't know if things make more or less sense, but it's always confusing in the moment.
Yep, very true. And I know Katie is also going to go over that too.
Yes, yeah, we have some good stuff coming up here. Cody, as you mentioned, coming into the beginning of this year, there was some talk. Once the intent of all the tariff actions started to hit the news and we got closer to that Liberation Day, there was a lot of question, a lot of concern around, all right, are we going into a recession? How is this going to impact things? And I think this chart is really interesting because it highlights some of the components of GDP. So that's the gross domestic product of the goods and services that we are producing here in the United States. And you can see the trend line over the last number of quarters. This is something that's measured quarterly. And when you talk about a recession, one of the definitions of a recession is to have two quarters of negative GDP. And in the first quarter, once again, in light of all the tariff actions, we did have a slightly negative GDP number. But second quarter, and also where third quarter is trending, is right about that 3.8% GDP number. And so the thing that's interesting, once again, kind of looking at the contributions, is much of that, a big driver for that is the net exports. So the goods, being shipped outside of the United States. On the other side, something to highlight is the change in private inventories. So that's looking at, what we are producing here domestically and recognizing we're not making it fast enough. So our inventories are going down at the same time that a lot of goods and services are being shipped out. Those are two of the biggest drivers that are showing up right now to get us to that 3.8 GDP number. But it's a good, solid, positive number. And you can see kind of historically fits in well with historical measures. And all indications right now are pointing toward another 3.8 GDP for the third quarter that's going to be coming out here shortly as well. So this is just kind of a good view on right now. We're not seeing a significant recession concern. As we mentioned, we're pretty high in a lot of measures of the economy right now and of the markets. Not to say that we're going to continue at this pace, and we're going to have some conversation about that, but there's a lot of production that's helping to support that. So let's move on to, we talked about the Federal Reserve as well. So the Federal Reserve cut rates in September for the first time this year, a 25-point rate cut, bringing the target down to about 4.25, and the federal funds rate. And as Cody mentioned, there's another decision coming up next week, and all indications right now are leaning toward another rate cut next Wednesday, and a very strong probability of a second rate cut before, well, I should say third rate cut, but third in total for the year, 3 rate cuts this year. Another one here coming at the end of the year. I think that's the strongest consensus right now, not to say that'll happen for sure. But what we're looking at here is basically what the Federal Reserve's mandate. So the Fed is in charge of balancing out that unemployment rate and also managing inflation. And when they cut rates, they kind of work on both sides of that. And this is showing us historically, going back 50 years, this is showing us historically how those two rates have been tracking. So we can see here on the green line, this is the unemployment rate. And obviously, we had a large spike here. And at the pandemic, we had a large spike in unemployment back at the financial crisis. And there are different times when that's happened. We're trending still pretty low on our unemployment rate. As we mentioned, there's a little bit of a softening that's happening, and the Federal Reserve is definitely paying attention to that softening. And that's a lot of the reason that they cut rates recently. But the other piece that they have to manage is inflation. And so that's this blue line. As Dennis said, for a long time, it was floating down here around 1%. And then we had the spike up in 2022 as we're managing the other side of the pandemic. And we've managed to bring that down, but it has been stubborn around 2.9%, which is not quite to where the Federal Reserve would like it to be. They want it to be at that 2% rate. So they have to be really careful when they make these rate cuts, because when they make a rate cut, they're helping hopefully the unemployment number to keep people employed, but they could also be spurring growth. And sometimes when they spur that growth, then we see the inflation coming along with that. So it is a fine line, but I think the thing I like about this chart too is we are not far off of very healthy levels with both inflation and also unemployment.
Yep.
All right. I'm going to toss this back over here or toss this to Dennis, if you want to talk through a little bit more about the Federal Reserve's movements.
Yeah. So one of the things that we talk to clients about sometimes is the importance or lack of importance of specific events. Things like, is the Fed going to raise or lower rates on, this particular date? What this chart shows in a very simple way is that there are certain rates the Fed controls, which is the very, very short-term rates. And there are things that affect you and I and the way we, borrow money and just the way the economy rates show up in the economy. So the 10-year Treasury yield is a much more important indicator for things like mortgage rates and some other borrowing rates that are related to how we live our lives. What this chart shows is that about 2/3 of the time when the Fed lowers rates, it lowers the 10-year Treasury rate. But there's a full third of the time when that doesn't happen. The Fed might lower and the 10-year goes up, or the Fed might raise and the 10-year goes down. And I think that's the part that we have to have some humility about, is to say, there are things that the Fed thinks it can control, but sometimes they're pushing on a string.
I think we're back.
Okay. Sorry, guys.
Sorry. Is this that Amazon glitch again?
I don't know. Honestly, it might be. I know they said they fixed it, but.
So getting into returns for this year, we're going to start on bond returns. And this is something that we actually talked about in market update going back 2 or 3 years when bonds had a really bad year in 2022. We talked about the best predictor of future returns, which is the yield that they have on the day you buy them. And you can see that a lot of returns so far this year, things like corporate bonds up 8%, treasury bonds up 7%. We're seeing yield appreciation as we're collecting that income, but also having the appreciation from rates coming down. So it's been a very strong year to 12 months for bonds. Even in the last quarter, we saw a lot of positive returns. This is something that really matters when it comes to financial planning, because again, flashing back to 10 years ago, if you weren't earning what stocks were providing, your alternative was to go into bonds that weren't paying you very much. And now you actually have the option of going into bonds that are paying a healthy yield. And that makes the planning conversation a little bit easier to maybe take risk off the table and still have, returns above the rate of inflation.
Yep.
This chart, I love this next chart, because in the past we've shown this related to stocks. What this shows, going back 50 years, is the annual returns of the aggregate bond index and then the inter-year lows. So you can see the red numbers are, at some point the bond market was down 5% one year and finished up 5%, or down 2% and finished up 4%. So far this year, the bond market at one point was down 3%, and year to date it's up 6%. I think the important thing a couple important takeaways from here. Even in safe assets, are down periods. Like this is not it's not a stagnant market. There are down periods. The other important thing about bonds and compared to stocks could spend the entire year bouncing around and then pop in 1 month, and you have all your returns come in a very short period. We had that happen in April. There were a couple of days where if you missed a couple of days in April, you missed a lot of the bounce back from the volatility. But bonds are different. Most of your return is going to come from the yield that they pay you. So you have to hold them for the entire year. Like if you have a downturn in the bond market in January, you still have 11 months to collect the income from them. So very steadily positive, only a handful of years negative over the last 50, but you have to be a patient investor in order to capitalize on that.
I think one other quick point about this chart too, Dennis, is as it says there, positive 44 out of the last 49 years. That's about 90% of the time. So when we talk about, building out a portfolio and building in some more stable assets, you said that doesn't guarantee that it's always going to go up, and doesn't guarantee during the year it will be positive, but there's a lot of stability baked into ending positive 90% of the time, versus the stock market has a lot of volatility as well. And I think on average it's positive about 75% of the time. So just to kind of put in context there, once again, it's nothing, well, yeah. When you talk about safety and stability, there's still, recognizing some potentially inherent risks, but.
Yeah. So that was one area where we kind of tried to manage expectations in years past for what was to come. Cody, talk about this other slide where, in April, we tried to manage expectations for the volatility.
Yep. So these two charts on the left side are what we went over in the first quarter market update of this year. So I'm sure everybody remembers when the current administration announced the tariffs that came on, we had a very fast sell-off in April. The bottom was around 20% from all-time highs. We went over, how normally when you have a lot of volatility, the VIX is a market index of volatility inside the US. When we have a lot more volatility, what were the average returns going forward inside of the stock market? So that was what we went over back in April of this year. This chart on the right side is going over the actual returns from the bottom of April to the end of close on October 16th. So the US growth stocks, we're using NASDAQ as a benchmark, was up 45%. The S&P 500, which is the major benchmark inside the US, was up almost 35%. International stocks were up almost 32%. And then we also put in two of the more stable investments on the bottom side. So the green line is the bond index that Dennis just went over. And then the purple or pink is money market. So I'm sure a lot of, people had concerns. Do we get out of the market? Is the market going to continue taking? Kind of as what Dennis and Katie were just going over on the previous slide of, the stability of bonds, having that balanced allocation in your portfolio. Maybe you were able to take advantage of that sell-off we had in April, sell a little bit of, the fixed income and get back into stocks to enjoy that bounce back.
One quick point on this, Cody. At what point did we get the all clear on tariffs here in this chart?
All the way over here when it was already up 30, 40%.
Yeah, if that, No,
I think there's still uncertainty around the tariffs and exactly what is going to be there going forward.
Yep.
One other chart going over the actual returns year to date so far and also in the third quarter. So it's been a very, very strong year for international stocks. I know we spoke about this at the end of last year going into this year, the valuation difference between US stocks compared to international. I know Katie's going to go over this in a little more detail towards the close of this presentation, but so far year to date, the best performing asset class has been international small cap, up almost 30%. Then we have emerging markets up almost 28%, and then international large cap up over 25%. It's still been a very good market for US large cap and US small cap, but seeing the outperformance for international, honestly, it's not that surprising based on the valuation difference. And we've been talking about having that balanced, diversified, account going forward. And then obviously we've been able to take advantage of that so far this year. I will also point out, if we look at year to date returns. So small caps up 10% year to date. Pretty much all their returns came in the third quarter of this year, up over 12%. So this again it is very, as everybody knows, very, very hard, if not impossible, to time the markets. You have to be there when you have the bounce back, which is what we've had for international stocks and US small cap stocks. So going forward, we'll go to Katie to go over, obviously, as we spoke about in the beginning, all the AI spending that I'm sure everybody has seen on the news. Yes.
This has been a huge topic of conversation, AI, and what does it mean, and where are we headed with AI? I'm going to start over here with the chart on the right for a minute. And the chart on the right, this is looking at, going back to 2014 up through current day. And this is looking at companies and how they have been performing, leading up to this line here, which is the launch of ChatGPT, specifically focusing on computer equipment, communication equipment, semiconductors, and then the green line being kind of all technology companies. And we can see the growth that they've had. And we know that we've been in a big growth boom. I mean, small cap values, I think, led the way in this last quarter, but really it has continued to be large cap tech stocks have really led much of the growth that we've experienced here in the US. But the way that it has taken off for those semiconductor companies and those companies that are supporting sort of the infrastructure of AI over the last couple of years is just astonishing. So that just a visual on that. But then on this side, this is looking at the expenditures for what they call the AI hyperscalers. So inside of this group, we're looking at Alphabet, Amazon, Meta, Microsoft, Oracle, and the amount of money that they are spending on AI and AI tools coming out. And this goes back to 2004. The gray bar showing in terms of dollars, how much is being spent, and this blue line in terms of percent. And we can see as a percent of their revenues, it's becoming an increasing amount. And so the big question is, there's a huge spend. And if they want to bring these tools to the masses, there has to be a huge investment. But will that investment pay off? And up to this point, they've had some revenues to support it. But the question is, are the revenues going to spike enough to continue supporting it? Or are we going to get into a place where they can't and things start to fall off? And so something that we're watching closely, definitely something that I know there's a lot of chatter about, is there an AI bubble forming, and, how much money is being invested in here? I do think there are some differences between where we are right now in the AI world versus other bubbles that we've had historically. But this is absolutely something that we're watching and trying to, see if the revenues are going to support the investments that are being made.
Yep.
All right. So
Did we get to talk about the dollar now?
Yes, we get to talk about the dollar now.
All right. So we've talked about international outperformance. There's a factor at play when we invest domestically and internationally, and that is dollar strength or weakness. And what this chart shows you, going back 50 years, is that there are long periods of time that part when the mountain is above the zero line, that's when U.S. stocks are performing international. Or excuse me, when international stocks are outperforming the U.S. When the line is below the equator there, that's when U.S. stocks are outperforming. And what the implications of this are that when the dollar is stronger, domestic stocks do better. And look at the last 15 years, really since the great financial crisis, U.S. stocks have vastly outperformed international. There's been a period in the desert for international stocks. That's changed this year, as Cody showed you in the performance. I think the important thing to remember, a lot of our memories don't go back this far. Like, this is a long time since we had international emerging markets. Excuse me. I remember early in my career in the 2000s, all we were being pitched were emerging market stocks and international stocks because the dollar was in a weakening period. And you can see that in outperformance. So when you ask, like, how do we make sure that there's some kind of a hedge or some way that we can manage exposure to dollar strength or weakness, it's by holding domestic and international stocks, because these cycles, they do move in waves.
Yeah. So Dennis, let's take a look at kind of shrinking down this chart to the period of that the first part of the 2000s, the great financial crisis, and then coming forward from there, and how valuations have changed. And I think this is really interesting, where we can see, as Dennis was just showing, this period back here, that first of all, the red line is representing US valuations. So the price to earnings ratios of US companies in the stock market. And the blue line is the international, non-US companies, and then the valuation trends that have happened over time. So when they were very close back here, we had quite a bit of outperformance in international markets. And then we get to the great financial crisis, and everything sort of reset. Coming out of the great financial crisis, as you just illustrated in the last chart, we've had this really long period of outperformance with the US markets versus international markets. And we can see, as that outperformance has occurred, valuations in the US have really taken off. And we've been talking about this for a while, the difference between sort of how the US market's being priced versus how international markets are being priced. And we're at a point here, even with the international really strong returns that we have happening this year, there's still a big gap between where that perceived value could be in investing inside of the markets. And I think something to point out is, anytime you're at higher valuations, it's reasonable to expect going forward, there's probably going to be a little bit of a normalization. At some point, these lines will probably come closer to converging. So just thinking forward, because the price to earnings ratio, that pricing is getting extended, and how long is that going to be supported by the earnings? And if you're at a really high point, now you have to expect prices to continue. You have to expect those earnings to continue at a pace that maybe isn't as sustainable. And so that's just something to be aware of, recognizing we still have a pretty big discrepancy here between where the US markets are at and where the international markets are at, and where potential growth could come from.
Good point.
All right, let's hand this over. Yeah, go ahead, Cody.
So this chart is going over, I'm sure everybody's heard of the Mag 7, and there's a lot of talk about, the top 10 valuations of the stocks inside the US. So this chart is going over what stocks were in the top 10 of the S&P 500 going back the last 40 years. The one thing that I think is very important to look at is just how often they change. And the color coding at the top, you can see the only stock right now that's in the top 10, Microsoft, was here for more than 10 years. Every other stock that's in the top 10 has only been here for 10 years, which is Apple, JP Morgan, and Berkshire, or is even more recent than that. So kind of going over what Katie and Dennis were just talking about, the valuations, obviously the spending inside of AI. A lot of these companies, have taken advantage of that, like NVIDIA, Amazon, Google, Facebook, Tesla, Broadcom. A lot of them have taken advantage and are spending the money to see how AI, will continue to grow their businesses going forward. But as we were just talking about, obviously the revenues going forward is going to be very important. So the most important thing on this chart is, and as we discussed before, you don't always want to just jump into what the current trend is, because I think the one thing that this shows is that changes year over year, and especially every 5 years. The fact that only, 4 of the companies in the top 10 right now were in the top 10 just 10 years ago, there is a lot of volatility of potentially what could happen going forward for some of these companies.
I'm going to point out one thing here, just to cherry pick one name on this list. Kodak was in the top 10 in 1985. Are people taking fewer pictures now?
Yeah, they are, but not with that.
Not with that. Well, there's more photography. So it just speaks to the changing, the evolution of not just what the business is, but how they run their business. And that evolves over time. And so I think we have to have a lot of humility about how all these companies are going to affect who the next 10 companies are going to be on the list. and that's always changing decade by decade.
Yeah. So let's bring it back to the fundamentals and kind of bring this whole conversation, full circle here, and really, reminder, focus on the things that matter and making sure that you have your plan in place, but also recognizing it's constantly changing, and you don't get to a goal and say, okay, I'm done. It's the next thing and the next thing and the things that come that you're not expecting. But if you have a good foundation of what you own, how you own it, where you're headed, the big rocks, if you have the big rocks in place, then it becomes that much more manageable. But never lose sight of that, especially as you're getting pinged with, the news flow of the day. And then, make sure to maintain that discipline and once again, not get too enticed to maybe go into areas that are riskier than you may be comfortable with, or you may have that perception of safety when maybe it's not there. So, staying disciplined with where you're showing up and how you're showing up, and also disciplined with your savings and your spending, and making sure it fits into the longer term plan. And then, we're always talking about diversification, rebalancing as necessary. Once again, those are all great disciplinary actions that you can, I shouldn't say disciplinary. Those are all great actions that you can take that are productive. So focusing on what really matters, and that all helps to create, that positive experience that you have with money, relationships, and life. And that's why we are here also at Morton Brown, to help create that positive experience. And so, we're so thrilled that everybody joined us today. Dennis and Cody, if you have some additional thoughts or comments.
Yeah, I think, thanks everyone for being here. We're going to shift over, just answer a couple of questions, things that have been coming up across our plates. Feel free to enter any questions you have in the chat. I'm happy to answer those. But there are some common themes that are coming up recently with the news flow. Well, let's start with, what are we telling our clients right now? I think one of the big things that we're doing is managing expectations, and that's so important right now. Just be mindful when you turn on the news. There are people who are paid to make predictions. That is their job. That's not our job, and it's not your job. But just acknowledge that the people that have to come up with a prediction for the end of the year because they have to have an opinion on TV. One of my favorite quips in investing is that being early and being wrong are indistinguishable. So if you're predicting a recession and you're early by 4 years, you're wrong for 4 years. And you don't need to be wrong for 4 years. So that's just a thing to be mindful of. What are some other things you guys are telling your clients right now?
I mean, kind of what you guys were saying at the beginning too, is just taking advantage of where we are right now. We're at all-time highs, in the stock market, both inside the US and international, pretty much all-time highs, in home prices. You can get a good yield from fixed income. So if you haven't done any rebalancing, maybe now is a good time. Not saying, that we're going to have a huge sell-off or anything, but if you don't need to take on the risk, and we just went over some of the high valuations, maybe now is a good time to do some rebalancing.
I had a meeting the other day also with a client, and they were talking about some things that they want to do to support some causes that are important to them. And they've been in discussions about a capital campaign. And so, we went to the drawing board and said, okay, this is something that you want to support. Let's take a look at the portfolio. And by the way, we identified specific positions to say, all right, we're going to put that in the charitable bucket. We're going to be gifting that appreciated stock. You get to take care of the causes that you want to take care of. And at the same time, we're also starting to de-risk the portfolio and rebalance through that process. So I think being, as Cody said, looking at where we're at and how can we be productive and how does that fit into the plan. And I think it is setting those expectations also. A lot of conversations with clients about setting the return expectations going forward. We don't know where things are going to go, but we know that we are extended beyond historical norms. And so at some point, whether it's a slow process that gets us there or it's some sharper movements that get us there, at some point things are going to, trend back closer to the mean.
Well, one thing I heard recently, and it was a reminder of a quote that I heard years and years ago. So there are professional investors, institutions, endowments, like the funds that need to earn a rate of return because they have long-term objectives. That's not you and I. You and I, we invest because our timelines are a very human timeline of life cycles and needs and everything else. And I say that because there was a quote from Chuck Prince, who was the CEO of Citigroup back in 2006, 2007 timeframe. I was part of that organization at the time. And they asked him, like, what do you think about the risks that are building up in the housing market and some of the risks in the banking system? And his only comment was, as long as the music's playing, we have to keep dancing. Meaning that if there's money to be made, we have to keep making money because that's what our shareholders expect, and we can't not make money. And at some point in the future, the music's going to stop and we'll just have to deal with it then. That's not you and I.
No.
Make decisions about managing risk and decide maybe this is our time to make a different decision, whatever that may be. But you don't have to keep dancing because you're answering to someone else. You're answering to yourself and your plan and everything else. So I think this is a good time to be reflecting on, what music are you listening to?
Yep.
One other thing I think is worth mentioning that's come up more recently than I think in a long time is gold and what's happening with gold. What do you think about gold? Mm-hmm. And one of the ways that we've approached that is that one, gold doesn't provide any yield. It doesn't pay you any income. It's been somewhat of a hedge against certain things like inflation in the past and everything else. But the way gold has behaved this year has been interesting because it really seems as though what ended up happening was there was some question about currencies, the dollar, sovereign nations saying, hey, maybe we don't have the exposure we need to something like gold versus what we have to the dollar and treasuries. We need to catch up. And suddenly countries and institutions started buying up a lot of gold. It wasn't like you and I and your neighbors buying it. There was an institutional demand for gold that kicked in. And that seems to be what's driven a lot of the price appreciation. But now there's also an element of it's become speculative, just like Bitcoin, just like housing, just like other things where people are just piling money in. Have you guys been feeling some questions about that?
A few questions. Yeah. And I think that's a good point because I think gold has been the place where you run to for safety. At least the thought process is if I'm concerned about this, then I buy gold because that's going to be, my safety play. And to your point, it can act very speculatively and it's not something that you're getting that income along the way. You're not getting all the benefits along the way. So it's a matter of, do you want to ride it or not? And does it make sense? It can also sit dormant for a long time too.
Yep.
Yeah, I think that was the lesson from the last couple of years is we had that large inflation spike, but gold didn't necessarily perform along with it. And so it's just, I think for some investors, there's a place for it, but the demand is largely for people who are not, individuals. It's a largely institutional demand and function there.
Yeah. And it is an understanding of what risk are you really taking on. Like I said, right. I think that's where a lot of confusion can come from, where I honestly feel as if I hear the questions about gold more from my more conservative clients than I do my risk takers. And so I think it's just kind of right sizing that conversation.
Yeah. I think one of the last things we want to cover, we're in the midst of a government shutdown right now. Cody, we had an extra slide on here that talked about market performance during a government shutdown. You want to share that real quick?
Yeah, we can definitely pull that up.
Yeah, we are 3 days now into this shutdown. Go ahead.
Yep. So this slide is going over what the S&P 500 did over the last, times we had a government shutdown. So every single time over the last 50 years when we had a government shutdown, obviously, the times and the days that we were in the shutdown is different every single time. One thing I think that is really important to point out is there isn't the largest decline we had was only 4% in the S&P 500. So I know a lot of people are concerned that we could have a huge sell-off from, a government shutdown. The most recent one that we had was in 2018. Obviously, this chart does not go over the most recent shutdown because right now we're still not out of it. Hopefully, they come to a conclusion here soon. But we're actually positive so far this year and, the 23 days that we've been in the government shutdown. So one thing, and as we always talk about, is yes, the headlines are important, but that doesn't mean you make drastic changes inside of your portfolio based on, a certain headline.
Yep. Katie, you know what I remember from that 12/22/2018? Mark, do you remember our first client appreciation event was in mid-December of 2018, and the market was down 20% at that time. So the market sold off 20%. We get into a government shutdown. The news was all negative, and yet look at that big up that we had while the government shutdown was happening, while we were in a 20% decline, and you got a massive move. So it just speaks to we have to be very discerning in how we look at the headline sometimes.
Absolutely.
It's the first time we had street noise in our new office.
Yeah.
That's a good point. We haven't heard any. Of course, that's why we're live. Well, listen, thanks everyone for joining us this morning. Feel free to reach out if you have any questions, if there's something we talked about today that maybe needs broader explanation or some context around it. We're grateful for all of your support and just the way you engage with our team. So thank you very much for being here this morning, and we will see you again in the new year.
Thanks.
See ya.